name is Gina Talieri, and I'm the Director of Development at the Estrella Foundation. And thanks so much for joining us for this webinar, Giving 101. We're doing this with the help and expertise of a couple of people who have really been simple. Eva Victor, a trust and estate specialist and attorney, and Connie Court, a chartered financial consultant from Penn Mutual. Penn Mutual has been gracious enough to allow them to share their expertise and their technology to give you this overview in planned giving. I also asked to say hello from our Executive Director, Bob Loda. She's coming back from the Philippines today, and I think at this very moment she's in the Tokyo airport. So I know she's sending positive vibes from Tokyo and is really, really glad that we're able to do this webinar today. Now, before we start talking about different vehicles, Estrella has a legacy giving program called We Will. It started a number of years ago. It has about 5 members who are good enough to make Estrella a beneficiary in their will. Planned giving has, as a whole, has many other options. Some complicated, some fairly simple. So we are going to be introducing some of the simpler options today. And I'm relying on Eva and Connie for their expertise. So let's get started. To a degree, every gift is a planned gift because most of us think about whom we're going to support, how much to give to our favorite causes. But charitable bequest, which is the name for planned gift, is different because for most of us, it offers the opportunity to make the single largest gift distribution in our lives. To make a transformational gift or gifts to organizations whose work means the most to us. Whether those organizations are, Smith College or Estrella or the Juvenile Diabetes Research Foundation or any combination. It allows us to define what we want to leave behind, both for the charity and for family and friends. And it's an option for virtually anyone who ever made a gift, who thinks philanthropically and wants to get involved. So let's get started. Eva?
Thank you, and good afternoon, everyone. Well, charitable giving can play a unique and valuable role in an individual's broader planning while making a lasting impact on a favorite charitable organization. In addition to offering the opportunity to fulfill a philanthropic objective, it can also offer a number of personal planning opportunities. In other words, charitable giving can allow an individual to fulfill a desire to contribute to a specific organization or cause, achieve recognition, and in some cases also accomplish other planning goals and objectives, including effective income tax planning, estate planning, retirement planning, survivor income planning, which we're going to discuss in a moment. In addition, financial products, including life insurance and investments, can complement some of the popular charitable planning vehicles, serving as the funding and liquidity to support the plan and an integral part of the planning. And I know that Connie's going to want to comment a little bit on that.
I think I'll do that later at that slide.
So, involved in the whole process. The charity's role, which I can speak to. If you want to create a gift to a charity you know well, or you want to create one to an organization you've just discovered, it's the charity's role to listen to what you want your gift to accomplish, to understand the financial commitment it's going to take to sort of get there, work with you so that it's a gift that that means something to the organization, that is helpful to the organization. And to help you articulate not just the amount of the gift, but how you wanted it distributed, what donor recognition you want, if any. Some people want recognition, some people don't. Where you want to involve those close to you before you make the gift, after it's received, etc. So the organization should be listening to you and what you envision as a gift. First step.
Also, there's the role of the donor's personal, legal, and tax advisor. An implementation of a charitable giving plan is the role and involvement of the individual's personal, legal, and tax counsel. A donor's personal attorney and tax advisor who will need to be retained for the preparation of any required legal documents, tax filings, the rendering of tax and legal advice that is particular to that donor's unique circumstances and planning objectives. And it's also important for all advisors, including donors' personal...
To call, I had to go off and call the audio. Now I'm trying to pick it up the other way. I'm having trouble now getting back to the webinar link. Because now since I'm on the phone.
So it's also important for all key advisors, including the donor's personal estate planning attorney, their accountant or CPA, as well as their financial advisor, all who play a distinct role in the process to coordinate their efforts and their expertise and work as an integrated team in order to achieve the anticipated results and the best results. Bonnie?
I will speak about the role of the financial advisor. The first role is to assess charitable desires of potential donors against backdrop of their entire financial picture. As a financial advisor, when I first meet or speak with someone seeking financial guidance, I take what is called a fact finder to find out the details of their particular financial situation. Financial advisors, whether we are insurance agents or securities registered representatives or both, are required by law to gather information from the client for what is called suitability. If a person comes to me with a charitable planning idea, I am obligated to go through this same process. If I discover that the potential donor does not have even the basics of financial planning, I will tell them so. But if all systems are go, then we can proceed to discuss charitable planning ideas and the financial products that are matched to them. The second role is to be the captain of your charitable planning team, which consists of your accountant, your trust and estates attorney with knowledge of charitable planning, and the development staff like Gina and Graham. There will be ancillary people involved.
Did you get everything okay, Carol? Are you all set? Oh, are you okay? Did you get everything?
There might be ancillary people involved as well, such as a real estate specialist, real estate or art appraiser, if one wants to give real property or personal property. The captain, my job is to make certain that the other advisors communicate and coordinate with each other and move the charitable planning process forward as directed by the donor.
This is Gina. If you are on the call and not speaking, you might want to put your phone on mute just so that everybody else can hear. Connie and Eva, I have a quick question. That is the number of people involved in creating a plan. I mean, this sounds like quite a lot of people. And I remember when I did my plan giving, when I started to plan it out, there just seemed to be a lot of moving pieces. So what's up with that?
Good question, and it really boils down to a team effort, as Connie was describing, where each party, including the donor's personal legal and tax advisors, who are familiar with all of the particulars of their client's circumstances, the financial advisor, and of course the charities representatives, they all bring particular expertise and skills to the table, and each party plays an essential role in the plan giving process. And that's what ensures that the intended plan comes together the right way and achieves the anticipated results.
Okay, thanks.
Okay, so we'll be discussing, there is really a broad array and variety of charitable giving techniques that can be matched to the particulars of an individual's circumstances, objectives, and preferences. Charitable planning can be initiated during an individual's lifetime, what we term inter vivos gifts, or following death with testamentary bequests. In addition, charitable planning can be accomplished through what's termed an outright or direct transfer to a charitable organization, or alternatively, it can be accomplished through split interest charitable vehicles, where benefits can be directed to both charitable and non-charitable beneficiaries, including the donor, spouse, partner, child, or other individuals. In a moment, we'll take a look at some specific types of charitable giving arrangements and what they can accomplish from the perspective of both the donor as well as the charitable organization.
I want to go over what I think might be obvious, which are the philanthropic incentives of charitable giving. If you're thinking about making a planned gift, then you are probably by definition a charitable person. If you're on this call, you're philanthropic, think about helping others and benefiting the community. And so those are the motivations for making a charitable gift. In terms of social capital, which is bullet number 3, to a certain extent, same-sex marriage has allowed more people to entrust their partners to support the causes that are most important to them. But for a lot of LGBTQ folks, having a plan could mean not having any say at all as to where your resources are going to go at the end of your life. Your investments, your assets, if you have a plan, are assumed by the government to support things that don't resonate with you, or assets can revert to a family member who may share your values or may not share your values, or may not even know what your values are. So the planning aspect of it, I think, is particularly relevant for LGBTQ folks. And a number of financial reasons as well about making a planned gift.
Consider including charitable planning in their estate or financial planning. Well, as I was describing, certainly this might include the desire to contribute to and support a shared common interest or a specific cause the individual identifies with, along with satisfaction and recognition for doing so. But note also, charitable giving is strongly supported by social, economic, and tax policy, and consequently offers a number of tax and financial advantages and incentives, including charitable income tax deductions and unlimited charitable gift and estate tax deductions for gifts and bequests to qualifying organizations. And as you know, was described, charitable planning can be appealing to individuals who want to maintain a sense of control and direction over their social capital. In other words, charitable giving strategies help determine how money and property, otherwise lost to taxes, will be spent, and enables the individual to direct resources to organizations and causes that are important to them, promoting voluntary philanthropy as opposed to involuntary philanthropy through taxation. Many individuals also have assets that may be subject to income tax, capital gains tax, or federal and state estate taxes. They're interested in ways of recapturing these tax dollars. So they're often searching for guidance and solutions on how to minimize taxation and estate erosion, support their communities, and fulfill philanthropic objectives. Charitable giving offers offers some significant incentives, including the opportunities for reducing the impact of income taxes and capital gains taxes, as well as estate and inheritance taxes. And in a moment, we're going to discuss some opportunities, including opportunities for personal retirement planning and survivor income planning, objectives that can be accomplished with various strategies.
So, Connie here, and I'm going to be talking about the role of financial products with respect to charitable planning. Financial advisor working with financial products over 3+ decades, I have the experiential knowledge of how these products actually work. Life insurance is probably the most versatile vehicle from the standpoint of charitable planning strategies, as well as the types of donors. Middle-income people who might buy a life insurance for a charity with a $100 a month premium to a wealthy donor who has given to the charity a large gift and wants to replace the wealth she has given away with an irrevocable life insurance trust. Up to life insurance is that you have to be insurable, or a policy that you now have no further need of, and which can be given to the charity. Life insurance for charitable planning purposes are the permanent cash value varieties, such as whole life, universal life, index universal life, or variable universal life. It not be appropriate because it is a temporary rental and the donor may outlive the term period. I will briefly touch upon the other vehicles. Deferred annuities are generally variable annuities with a variety of sub-accounts from which to choose, and this matches with the NIMCRUT, which Eva will talk about later. Single premium immediate annuity, where a lump sum of capital has been converted into a stream of income, sometimes for life, can be purchased from a commercial insurance company to ensure the charity's obligation under a charitable gift annuity arrangement. Finally, stocks, bonds, mutual funds, and asset management programs can be utilized as vehicles funding either a charitable remainder trust or charitable lead trust, and of course an IRA.
So we've talked a little bit about the who and the why, so now let's dig into how. As we mentioned earlier, there are really a broad array of charitable giving techniques that can be matched to the particulars of someone's circumstances, objectives, and preferences. Again, charitable planning can be initiated either during one's lifetime with lifetime gifts or following death with testamentary bequests. And perhaps the most common and popular means of making a charitable gift or a bequest to a favored organization is what's termed an outright direct gift or bequest.
So what is examples of direct gifts? Cash, of course, is a wonderful direct gift. All or part of your retirement or 401k fund, a share of your stock, own a piece of land or an apartment, you can that to the charity. You have something collectible, like a piece of art or an antique from your family that's highly valuable. That can be given to the charity, which the charity would subsequently sell and convert the item into revenue. Eva, why don't you tell us why someone would want to make a direct gift?
Well, I think this question can be answered by who the profile donor is. Typically, these are individuals that have assets such as appreciated or low-cost basis marketable stocks, securities, or other investments, or even real property, perhaps non-income producing or underperforming assets, non-mortgaged real estate, or as you said, even an interest in a qualified retirement plan or an IRA. Also, life insurance policies or proceeds can be the subject of a charitable gift or bequest, as you had mentioned. The donor, however, may raise the question of how a particular charitable giving strategy might impact the legacy that they intend to leave to their family and heirs. And, as Connie will elaborate on a little bit later, life insurance for the benefit of heirs can provide a practical solution in replacing the value of a significant charitable gift or bequest. So let's frame who would be the right person for a direct or an outright gift or bequest, and what are some of the tax or financial benefits? Well, a direct gift is one in which the entire interest in the property is given to charity immediately. Transfer to the charity is not deferred, and the donor or other individuals, such as the donor's spouse, partner, or child, do not retain any interest in or income from the transferred asset. And later on, we'll distinguish a direct gift or bequest from what's termed a split interest gift or bequest. Some advantages of a direct or an outright transfer include, first and foremost, the appeal of simplicity. Involves simply the transferring of the title of the asset to the charity, or including a bequest under the will, or perhaps changing the beneficiary designation on an asset to the charity, generally without the implementation of other complex planning documents. So advantage includes the satisfaction in seeing that the charity benefits immediately from this gift or bequest, putting the resources to work toward charitable purposes right now. Also, the ability to implement this strategy, this can be done without a large or a significant financial commitment. It can be practical, even with a modest financial commitment. It also offers the opportunity for a current income tax deduction and reduction of estate taxes. Note, however, this particular strategy presumes that the donor or the donor's heirs not have the need or desire to retain any control over the asset or the income from the asset after the transfer to charity occurs, or the need to recover ownership of the asset in the future. If instead these are significant planning objectives or concerns, we'll be discussing some alternative strategies a little bit later on in the presentation.
Okay. So can you talk a bit, Eva, about charity-owned policy and the donor-owned policy?
Yes. Financial assets such as appreciated stocks, securities, mutual funds, life insurance policies, and retirement plan assets can themselves be popular subjects of charitable gifts and bequests. Insurance in particular plays a vital role in many aspects of estate and financial planning, and can also be used to provide a charitable gift or bequest, whereby the policy premiums paid can be leveraged into many times their value to provide a charity with an amplified legacy upon the insured's death. Now, in some circumstances, it may be desirable for the charity to be both the owner and beneficiary of the life insurance policy, and gifts of cash or appreciated property to the charity can supply the funds to pay the premiums. Premium gifts will generate a current charitable income tax deduction for the donor, subject to limitations based on the donor's adjusted gross income. And gift of an existing life insurance policy will also generate a current charitable deduction based upon the lesser of the policy's cash value or the premiums paid on policy's basis. And the proceeds will be excluded from the insured's estate at death. As an alternative, the insured instead can retain personal ownership of that policy and designate one or more charitable organizations as the policy beneficiaries. The advantages of this strategy is that the insured donor retains control over the policy and access to the policy cash values for anticipated lifetime needs. However, since the policy is not owned by the charity, there won't be a charitable income tax deduction for the policy premiums. And the donor's estate will receive a charitable estate tax deduction for any proceeds passing to a charitable beneficiary upon death, eliminating estate taxes.
Okay.
I'm going to make a few comments on the product side. If the charity owns the policy, the charity can borrow against the cash value, or in certain types of policies, take partial withdrawals.
Mhm.
There does have to be an insurable interest between the charity and the donor. For instance, it has to be a donor that has been contributing along the way. One issue for the charity is if the donor comes into hard times and cannot give the gifts of the premium to the charity. However, as in the case of whole life, where there is a balance between protection and cash value buildup, the dividends, which are not guaranteed by any insurance company, could possibly pay the premiums down the road. Offset, which means the dividends come in at a certain time, around 15 to 20 years, or you could set up from the outset a premium payment period such as 10 years. On the other hand, if the donor owns the policy and controls all of the rights of the contract, then this means that the donor insured can change the beneficiary, which means that the charity may not receive part or all of the proceeds upon the death of the insured.
An IRA or interest in a qualified retirement plan may be subject to taxation at the time of the owner's death. That includes federal income taxes, perhaps federal estate taxes, as well as state income, estate or inheritance taxes, and perhaps any other asset comprising an estate. These retirement assets are likely to experience the most erosion at death due to this combination of taxes. Consequently, a charitable bequest of an IRA or an interest in a qualified retirement plan like a 401k or 403b can be a really tax-efficient way to fulfill a charitable objective. The IRA owner or plan participant would simply designate one or more charitable organizations as the beneficiary of the plan. Income tax will be eliminated on the IRA or qualified plan at death, since the charity is an income tax exempt beneficiary. The charity can then liquidate and reinvest the proceeds of the plan with income tax consequences and apply for charitable purposes. The donor's estate will also receive a charitable estate tax deduction, eliminating any estate taxes on the IRA or plan balance at death. And of course, life insurance can be used to replace the value of an IRA for donors' heirs, ensuring that their inheritance is preserved. Also, a life insurance policy owned by the charity, as we were discussing previously, or proceeds payable to a charity can also amplify the legacies the charity ultimately receives.
And it would be is that if a spouse or partner or child is unhappy that they're giving away their inheritance, I would recommend a wealth replacement life insurance. Of course, understanding that if you don't have a policy previously, you would have to be insurable.
And of course, the proceeds of the life insurance policy would pass to those heirs free income taxes, the IRA that they would otherwise inherit.
Exactly.
Oh. So this is, I think, a particularly interesting and valuable point for younger people who want to think about planned giving. A lot of people in their 20s and 30s don't think of themselves as having money because, you know, they're just starting out and they're saving for a house or whatever. But if you're working, you probably have an IRA, and there's significant money in there. It's part of your long-term planning. So for those listening or thinking about giving, don't overlook the value of the IRA and what it could do to an organization, especially an organization with, you know, where several $1,000s can make a huge difference in what they do.
Yeah, and another strategy that can be taken with this asset is the owner could name the surviving spouse as the primary beneficiary. And they could wait and see, and that spouse, if they don't need the IRA money, could disclaim IRA in favor of one or more charities, and that way you could just take a wait-and-see approach. Or you could accept the IRA, do a rollover, you know, utilize it during their lifetime, and then following second death, name the beneficiary, the charity, the beneficiary of the IRA. That way you'd preserve the use of that asset for a surviving spouse if that's the way you ultimately want to organize your plan.
That's good to know. I didn't know that. My own interest, so good to hear. Okay, the second kind of giving vehicle we're going to talk about is a so-called split gift because there's more than one beneficiary. They're a little more complex, but there's a lot of benefits to doing a split gift. So let's take a look at them.
Okay, up until this point, our discussion has been centered exclusively on what we've termed outright or direct gifts and bequests to charity. Transfers in which the entire interest in the asset is assigned to charity irrevocably, and where the donor and donor's heirs do not have the need or the expectation of retaining any interest in the transferred asset or the income from the asset, or ultimately recovering ownership of the asset. However, depending upon the nature of that asset and the donor's particular planning objectives, concerns, and circumstances, this may call for consideration of a split interest approach. Planning vehicles that can provide benefits to both charitable and non-charitable beneficiaries, including the donor, spouse, partner, child, or other individuals. The direct transfers we were describing, a split interest transfer will provide tax benefits in the form of alleviation of income taxes or capital gains taxes and estate taxes. However, with the cost of added complexity and generally a larger financial commitment in order to make the strategy economically practical or feasible. However, in contrast to a direct transfer, a split interest transfer will allow the donor or other non-charitable beneficiaries retain an interest in, income from, or ultimately recover ownership of the asset that's going to charity.
So that's a split interest, right? Because there are multiple parties benefiting from the asset?
Right. The interest in the asset, so to speak, is split or divided between charitable and non-charitable beneficiaries.
Okay.
So let's first consider an example of a widely promoted split interest charitable giving vehicle, the popular and versatile Charitable Remainder Trust, also known as a CRT. A CRT is an irrevocable split interest trust that serves both charitable and non-charitable purposes. It's designed to benefit the donor or someone else the donor chooses for a period of time by charity or charities of choice. During the trust term, which is typically for the donor's lifetime or perhaps the joint lifetime of the donor and another individual, such as a spouse, these non-charitable income beneficiaries receive an annual payout from the trust equal to a fixed percentage of the value of the property that was contributed to the trust. And note that the CRT can be designed with a feature to allow deferral of these payments and income taxes on these payments until a future time, such as post-retirement years. And tax-deferred annuities can make very good funding choices for these vehicles. And he's going to elaborate on that in a moment. Then, at the end of this trust term, typically following the death of the donor or another chosen income beneficiary, trust property, or what we'll call the remainder interest, will pass to charity. So the appeal of a CRT is that it permits the donor or someone else to retain the income from the property transferred to the trust, while providing for a deferred gift or bequest to the charity or charities of choice, and affording a number of tax and non-tax benefits. What are some of those benefits? Well, a CRT is an income tax exempt trust. This gives the donor the ability to contribute an appreciated or perhaps low basis or maybe a non-income producing or underperforming asset to trust, which can sell that property and reposition it with the capital gains tax haircut. So those sales proceeds, undiminished by capital gains taxes, can then be immediately reinvested and managed for the donor, spouse, or other individual to give them increased lifetime income. This enables the donor to convert an otherwise non-productive or non-income producing asset into a valuable source of supplemental income. In addition, the donor will receive a current charitable income tax deduction for the contribution they make to the CRT based upon the value of the charity's remainder interest in the trust. An income tax deduction can be particularly valuable in a year where significant income might be realized, such as a year where you might consider converting a traditional IRA to a Roth IRA, or maybe receiving a deferred comp benefit from an employer, or even selling a low basis or an appreciated asset. CRT planning can also help reduce estate taxes since the value of the charity's remainder interest is going to be sheltered with a charitable gift or estate tax deduction. CRT can be created and funded either during the individual's lifetime, what we call an inter vivos CRT, or following death, what we call a testamentary CRT. So CRTs are quite versatile and can be used to support an individual's estate planning, retirement planning, survivor income planning objectives, as well as some other objectives. Now here again, the donor might raise the question of how this strategy might impact the legacy that they intend to leave to their family and heirs. After all, it's the charity who's going to receive the asset ultimately at the end of this trust term, not the donor's family. So here again, life insurance for the benefit of the heirs can provide a practical solution, replacing the value of the charitable gift or bequest. So for the right situation, for the right candidate, a CRT can be a very appealing strategy for a number of tax and non-tax reasons.
My comment here is the extra income that would be coming in could pay the premiums on the life insurance.
Yeah, the advanced income from the CRT, or even the tax savings generated by the upfront income tax deduction.
Correct.
And the
From the survivors could pay from the income they're getting to pay premiums?
Yes. Actually, the donor can pay the premium on the policy from the enhanced income that she is receiving from the trust.
Right.
And a lot of people look at the tax savings associated with the upfront charitable income tax deduction and the alleviation of capital gains tax on the sale of that asset as found money, which of course can be applied directly toward premium payment. Right. So the CRT can be a vehicle that can indirectly assist with the funding of that policy through the tax benefits with the enhanced income.
Well said, Eva.
Okay, so let's take a look at another very popular split interest charitable giving vehicle, what's called the Charitable Lead Trust, also known as CLT. It really can be considered almost the reverse or mirror image of the charitable remainder trust that we were just talking about. The CLT is likewise an irrevocable trust, split interest irrevocable trust that serves both charitable and non-charitable purposes. Likewise, can be initiated either during the donor's lifetime, CLT, or following the donor's death, the testamentary CLT. Now, there are two distinct varieties of charitable lead trusts that serve different planning purposes. The reversionary CLT and the non-reversionary or family CLT. In the case of a reversionary CLT, a chosen charity or charities receive a fixed percentage payment over the term of the trust. They have the leading interest. That term is commonly a term of years. And the donor, who is the remainder beneficiary of this trust, actually reacquires that property following the trust term to use for future personal needs, perhaps post-retirement income. Note, because the property is reacquired by the donor, it's included in the taxable estate. So it's not a particularly a tax-efficient strategy from an estate tax standpoint. So typically this would be considered by someone who doesn't have any concerns about federal estate taxes. The CLT, unlike the charitable remainder trust, is not an income tax exempt trust. So the grantor, the donor, is going to remain taxable on the trust income, same as they were when they actually owned the asset outright. However, they're going to receive an upfront current income tax deduction for the value of the charity's income interest, the present value of the anticipated stream of income that the charity is going to be receiving over that term. Now, contrast, in the case of what we call a family CLT or a non-reversionary CLT, the charity receives a fixed percentage payout over the term, but the donor's family and heirs are the remainder beneficiaries following the charity's term. And this type of CLT offers the donor an opportunity for a highly efficient transfer tax planning opportunity, since it actually discounts the value of that remainder interest that ultimately passes to the heirs for both gift and estate tax purposes. So for individuals who do have a concern about federal or state estate taxes, they might be more inclined to go the route of a family CLT rather than a reversionary CLT. Life insurance also plays an important role in CLT planning. Life insurance can replace the value of the charity's income interest for the donor's family and heirs, ensuring that their inheritance is not diminished. And in addition, a life insurance policy owned by the charity amplify the legacy the charity ultimately receives. It can replace the value of the charity's income stream following the trust term, and the charity can use the income it's receiving from that trust to fund the policy premiums.
Okay. So now I'm going to just mention, I'm just going to introduce charitable gift annuities. Just for those listening, Estrella does not offer charitable gift annuities, but a lot of large nonprofits like universities and hospitals and major museums do. So Eva, maybe you should just cover the basics here. So we leave time for questions, and people can pursue a charitable gift annuity if it seems like it's right for them.
Absolutely. So we'll take a look at, a final split interest charitable giving vehicle, and a quite popular one that can achieve many of the same benefits of the charitable remainder trust, which we talked about a little earlier, but without the necessity of establishing and administering a trust. Charitable gift annuity, or CDA, is a contractual arrangement, a formal, legally binding agreement between the donor and charity that provides financial benefits to both charitable and non-charitable beneficiaries. It's also a split interest gift that's designed to benefit the donor or another individual, as well as the charity of choice. So how does it work? Well, the donor makes a transfer of cash or other property, commonly appreciated or low-basis property, to a particular charity. And in exchange, the charity agrees to pay a fixed, guaranteed annual payment, what we term an annuity, to the donor or another individual for life. This annual payment is based upon the individual's life expectancy, or in some instances, the joint life expectancies of one or more individuals, perhaps a donor and donor spouse or partner or child. We'll typically use the rates that are published by the American Council on Gift Annuities, the ACGI. Most charities will follow those rates. These payments can begin immediately, or they can be deferred until a specified date in the future, such as post-retirement years. So what are the particular benefits of a gift annuity arrangement? Well, charity, which is tax-exempt, can liquidate and invest low-basis or appreciated property that it receives from the donor without the capital gains tax haircut. The donor or another individual, such as a spouse or a partner or a child, can receive the income payments for life or even for joint lives, providing for survivor income. These annuity payments received from the charity receive favorable income tax treatment based upon an exclusion ratio. So that can defer recognition of gain on appreciated property over the lifetime of the annuitant. The donor also receives a charitable income tax deduction up front based upon the difference between the value of the property given to the charity and the value of the anticipated income payments they're going to be receiving back from the charity, their stream of income over life. Value of the charity's interest is also sheltered from any gift or estate tax consequences with a charitable gift or estate tax deduction. And here again, life insurance can replace the value of that donated asset for heirs, ensuring that their inheritance is preserved. Or a life insurance policy owned by the charity or proceeds payable to the charity can amplify the legacy that the charity ultimately receives.
So we're going to open up to questions from the audience. Keeping in mind that Eva can't answer specific questions about your planned giving strategy. And if you have questions about Estrella's legacy program, I'm happy to answer those offline. But, please let us know if you have questions. I want to kick it off with a question because this is a lot of information, Eva, a lot to think about. What do I do next? If I think, gee, this is a good thing to do. I have a couple of charities that are really dear to my heart. What next step?
We had talked earlier about the need to involve all vital advisors in this planning process. I would suggest that the key advisors, which would include the individual's personal attorney, estate planning attorney, their tax advisor, their accountant or CPA, their financial advisor, as well as a representative of the charity, be involved in this discussion together early in the process. So the individual would need to reach out to their personal attorney and CPA, let them know of their interest in making a charitable donation, and engage them in that dialogue, and then share that information with other key advisors on the team. If I have a lawyer, I mean, what if I just do my own taxes and I don't have a lawyer? Right. Well, some of the strategies we discussed here, particularly the split interest strategies that would involve the creation of legal documents, agreements, trusts, would require you to engage appropriate counsel, somebody who has expertise in estate planning and charitable planning. One place you might look for some leads might be friends and acquaintances who've had good experiences with attorneys in the community, and obtain some leads through that means. There's also a lead directory by the name of Martindale Hubbell that's been around for more than a century, and I have an online resource called lawyers.com.
Okay.
You go into that, you'll be able to look in their drop-down boxes, indicate the city and state you live in and the area of expertise you're looking for, say charitable giving and philanthropy. And what can come up in that search engine is a profile of all local practices, law practices, that hold themselves out as having expertise in this area, along with their contact information, their phone numbers, their emails, and you might be able to find someone through that means.
Okay, so I could drop down under charitable giving and philanthropy. That's the phrase I should be looking for if I'm on lawyers.
Exactly. Yep. Along with estate planning, New York, or whatever the city and state that you're a resident of. And what should come up is a profile, a detailed profile of every practitioner in that geographic region that holds themselves out as having the expertise in planning and charity.
Great to know.
And I would also add that it's really important to talk to your financial advisor, because you may have holes in your existing financial plan, such as not having disability insurance or whatever. These are kind of things that a professional will go over and say, yes, you can do your charitable planning within your budget, but if there's certain holes in your financial plan, you will plug the holes before doing the charitable plan.
Right. Another good source for looking for local expertise could be the local bar association. A lot of local bar associations, particularly in major metropolitan areas, have subsections or subcommittees devoted to the public interest or philanthropic planning, and that might be a good lead to find somebody with the expertise that you need at a local level.
Okay, great, thanks. Other questions?
It looks like in the chat box we have a question that relates to what is wealth replacement life insurance.
Mm-hmm.
Connie, would you like to?
Yeah, I think that if you're giving a major gift, whether it's a split interest gift or another gift, a direct gift, the life insurance actually replaces what's given away. So for the family that is, they could say, why did you give this gift away?
Right.
I would expect inheritance. Everyone is happy at that point. The charity's happy, the family's happy. It could be if it's a donor where they are in a estate planning situation, it could be an irrevocable life insurance trust purchased by the trust, or it could be owned directly. So it's really a way of leveraging so that everybody's happy, the charity, the family, and the donor.
Right. It's really not the term wealth replacement doesn't describe a particular type of product. It really more describes the role of life insurance for these particular strategies. So that, if there's a concern, if you're giving away a significant asset to a charity, what's the impact going to be upon the family and heirs' inheritance? So to prevent them from experiencing a diminished inheritance as a result of that request, life insurance fill that gap. And, as we mentioned earlier, it's a benefit that would be paid free of any income taxes and estate taxes structured properly. So everybody wins, the donor or the charity.
Great. Sounds like a great solution. Any questions? Well, I am so indebted to you, Eva, and to Connie, and to Penn Mutual for sharing this space and this time and all of your expertise. We have recorded the webinar, so anyone who's registered for it will be sending it to, and it'll also be on the Estrella Foundation's website. And if, like me, you're thinking, gee, what do I want to do next? There are lots of resources for next steps. There are many companies that offer plan giving guidance, and Connie is one of those people who are certified to do so. You can call anyone you like. There are ads for it on television all the time, but we have included Connie's contact information on the information that you're seeing if you want to touch base with her. As I mentioned earlier, Estrella has a plan giving legacy society called We Will, made up of some wonderful people who have thought out keeping the movement alive after they're gone. And if you would like more information on how you can include Estrella in your charitable planning, I ask that you call either me or my colleague Graham Bridgman, and Graham's information is up on the PowerPoint right now, or just get in touch with development@estrella.org, and we will get your email and respond to you. So, any last thoughts, Eva, Connie?
Not unless there are any comments or any questions that we could address for you. It's a great opportunity. In the tax environment in particular, really, today's tax environment really lends itself to considering incorporating these strategies into the broader estate or financial plan. that you're otherwise considering. So it's a very timely topic.
Mutual is very happy to, be doing this webinar for Estrella.
Yes, happy to